Money has a funny way of getting noisy. Your phone pings with hot stock tips, a friend swears that options are easy, and somewhere between your morning coffee and your commute, the market moved 0.5% and it feels urgent. Meanwhile, you just want a simple way to grow your savings without becoming a full-time analyst. That is the situation most people are in. Too many choices, too much jargon, and very real stakes because your future lifestyle depends on the decisions you make when nobody is watching. I like calm systems that work while you live your life, and ETF investing is exactly that. If you have ever wished investing could feel like putting your money on a steady conveyor belt instead of a roller coaster, you are in the right place. Quick favor before we start. If you like clear money breakdowns and simple experiments that you can copy and adapt, tap like and subscribe, and tell me in the comments what your first ETF might be or the hurdle that keeps you on the sidelines. That helps me tailor the next round of guides so we keep this practical. Here is the high-level picture. There are two big problems in modern investing. One is complexity that eats your time and confidence. The other is cost that quietly eats your returns. ETFs solve both by bundling hundreds or thousands of investments into a single share that you can buy in seconds, often for a fee that is measured in hundreds of a percent per year. In 2025, more Americans than ever are putting their savings on autopilot with ETFs for retirement accounts and for general brokerage accounts. And it is not because they love finance, it is because this is the lowest friction way to get market growth without babysitting it every day. You do not need to guess which company wins. You do not need to time the perfect entry. You pick a few broad funds, set up recurring buys, and go about your week. I'm going to show you how to make that your default with plain language and clean steps. We will start from zero, and by the end you will know exactly what to buy, how to place the order, how to avoid common traps, and how to keep it running with minimal effort. If the market chatter has ever made you feel behind, I want you to feel the relief that comes from a plan that is boring and effective. Boring is underrated when boring turns into wealth. Let me start with a crisp definition. An ETF, or exchange-traded fund, is a basket of assets that trades like a single stock on a US exchange. One share can give you exposure to hundreds or even thousands of companies or bonds in one click. Prices update throughout the day so you can buy or sell during market hours, and most brokers let you buy fractional pieces so you are not blocked by the share price. Why does this matter for you? Because the real goal is not to feel smart about finance. It is to build options and calm. You want a future where work is a choice, where a surprise expense is annoying but not scary, and where your money can grow even when you are busy living life. Broad ETFs get you there by delivering diversification, low cost, and tax efficiency. Diversification means your money is spread across many names, so a single company slip up does not wreck your plan. Low cost means the expense ratio, the annual fee the fund charges, stays tiny. For broad US stock ETFs, you will see fees near 0.03%. On $10,000 invested, that is $3 a year, which is less than a fancy coffee. Tax efficiency matters because most index ETFs in the US rarely distribute capital gains during normal operations, so you usually control when you realize gains by deciding when to sell. Now picture a concrete outcome. If you put $300 a month into a broad stock ETF and it earns an average of 7% a year over decades, the math says you could cross around $365,000 in 30 years. At $500 a month, it is roughly $608,000. Those are not promises. Markets can swing, but that is the compounding engine you are harnessing. Your job is to create a simple pipeline, use a tax-advantaged account like a 401k or an IRA for retirement dollars when you can, and use a standard brokerage account for flexible goals. Keep cash for emergencies in a high-yield savings account so you are not forced to sell investments at a bad time. Then let the ETF do the heavy lifting. You can start with a total US stock market fund or an S&P 500 fund as your core, add bonds when you want smoother swings, and add international stocks if you want global coverage. Simple does not mean shallow here. It means fewer moving parts so you can stick with it through good days and weird headlines. If ETFs are so straightforward, why do so many beginners still get stuck? 3 categories of friction show up again and again. The first is behavior. Your brain hates losing money more than it likes gaining it, so a red day feels twice as loud as a green day. That can push you to stop investing or to tinker at the worst moment. News and social feeds amplify this with endless opinions and the occasional miracle stock. The second friction is cost that hides in plain sight. You will see expense ratios on fund pages, but there are other small costs. The bid-ask spread is the tiny gap between what buyers bid and sellers ask. On big liquid ETFs, it is often a penny or two, but on niche funds, it can widen and quietly tax each trade. There is also tracking difference, the slight gap between the fund return and the index it tries to match after fees and operations. With well-run index ETFs, this is usually small, but it is real. The third friction is structure and taxes. Buying and selling the same day can tempt you into short-term capital gains, which are generally taxed at your ordinary income rate, not the lower long-term rates you get after holding more than a year. In a taxable account, dividends may be taxed along the way unless you are in a tax-advantaged wrapper. There is a wash sale rule that disallows a capital loss if you buy a substantially identical security within 30 days before or after selling, which matters if you try to harvest losses. There are brokerage nudges too. Zero commissions make it easy to click. Options links are always nearby. Margin can look like free money. None of that is evil, it is just a lot of candy in the checkout aisle. Then there is the myth layer. You do not need to find the next unicorn to build wealth. You do not need to wait for a market crash to begin. You do not need thousands of dollars to start. You need a structure that reduces decisions and a default that you trust when the noise gets loud. Getting those frictions out of your way is the real unlock. Once you see them, you can design around them. You can choose broad funds with microscopic fees and deep liquidity. You can pick a schedule and automate buys so you are not negotiating with yourself every Friday. You can keep taxes simple by using retirement accounts first and holding long-term in taxable accounts. That puts you back in control. Here is the simple mechanism I rely on. Use a broad, low-cost index ETF as your core, automate a steady contribution, and match your mix of stocks and bonds to your need for growth and your tolerance for swings. That sentence is the whole playbook in plain English. Let me unpack it. A broad index ETF is just a fund that mirrors a big, well-known benchmark. A total US stock market ETF owns thousands of US companies across sizes. An S&P 500 ETF owns the largest 500 or so. Both give you instant diversification and are cheap. Cheap matters because of compounding in reverse. A 1% annual fee on a portfolio compounded over 30 years can eat tens of thousands of dollars compared to a 0.05% fee. The expense ratio is the number to watch. I like it under 0.11% for core stock exposure when possible. Automating a steady contribution is dollar cost averaging. You pick a dollar amount and buy on a schedule regardless of headlines. When prices dip, your fixed dollars buy more shares. When prices rise, you buy fewer. Over time, you build a position at an average price without having to time anything. Matching your mix is asset allocation. Stocks historically deliver higher average returns and bigger ups and downs. Bonds usually move less and can cushion drops. A common rule of thumb is to start heavy in stocks when you are far from needing the money and to add more bonds as your timeline shortens or your risk tolerance demands smoother rides. One simple glide path for a long horizon could be something like 80 to 90% stocks with 10 to 20% bonds in your 20s and 30s, then gradually increasing bonds later. It is not a law, it is a starting point. Now, a quick worked example. Say you invest $400 a month into a broad US stock ETF and $100 a month into a US bond ETF, a 80 to 20 split on 500 total. If stocks average 7% over time and bonds average 3%, your blended expected return might land somewhere near 6%, depending on the period. Over 25 years, those steady contributions could grow to around $330,000. With the equity side doing the heavy lifting and the bond side smoothing the ride. Markets will rarely deliver clean averages year by year, so the job is not to predict next quarter. The job is to keep funding the plan, rebalance once or twice a year to your target mix, and stay boring in public and brave in private. Let me walk you through how I would set this up from scratch. First, I open a reputable US brokerage account. If I am saving for retirement and my employer offers a 401k with a match, I contribute at least enough to get the match because that is an instant return I cannot get anywhere else. Then I add an IRA on my own, Roth or traditional depending on my tax situation, and I also keep a standard brokerage account for flexible goals. After that, I fund the account. It can be $50, $500, or $5,000. Fractional shares mean the starting number does not matter. My core choice is a broad US stock ETF with a tiny expense ratio. A total market fund gives me thousands of companies. An S&P 500 fund focuses on the biggest names and is perfectly fine too. For bonds, I prefer a core US aggregate bond ETF that holds treasuries and high-grade corporates across maturities. If I want global stock diversification, I add a developed markets or total international ETF later, but I do not force it on day one. Simplicity beats enthusiasm. When I place the first trade, I search the ticker, choose buy, and enter a dollar amount. On widely traded ETFs with tight spreads, a market order during normal hours is usually fine for small amounts, but if I want to be fussy, I use a limit order a few cents near the current price and let it fill. Then I set a recurring purchase on payday, so money moves without me deciding each time. I turn on dividend reinvestment, so any distributions buy more shares automatically. I keep an emergency fund in cash, 3 to 6 months of expenses depending on how stable my income is, so I do not have to sell investments at a bad moment. I write down my target mix, like 90% stock and 10% bond or 80 and 20, and I put 2 dates on the calendar to check in, maybe every June and December. At those check-ins, I look at drift. If stocks ran hot, and I am now at 94 and 6, I sell a sliver of the stock ETF and buy the bond ETF to get back to target, or I direct new contributions to the lagging side. I do not chase charts. I do not swap funds every headline. The goal is a pipeline that keeps moving. If you do this, the day-to-day noise will feel less personal. You are not guessing, you are running a system. A quick tour of the plumbing makes your plan stronger. Accounts come first. A 401k or 403b through work often includes low-cost index options. Contribute enough to get the full employer match, since that is free money with a vesting schedule. Beyond that, an IRA gives you control. A Roth IRA uses after-tax dollars now and lets qualified withdrawals be tax-free later, which is powerful if you think your tax rate in retirement will be the same or higher. A traditional IRA gives you a deduction now if you qualify and taxes later. Many people do a mix over their lifetime. For flexible goals, a taxable brokerage account is perfect, and ETFs shine there because of tax efficiency. Most index ETFs in the US use an in-kind creation and redemption mechanism that allows them to kick out low-basis shares to authorized participants instead of selling and realizing gains inside the fund. Translation: fewer taxable capital gains distributions along the way, so you control taxes mostly when you sell. Dividends still show up. Many broad stock ETF dividends are qualified and taxed at lower long-term rates if you meet holding period rules. But check your specifics. Now the numbers that make this concrete. If you invest $6,000 a year in a Roth IRA from age 25 to 35, then stop, and it grows at an average 7%. By age 65, you could see around $650,000, all else equal and ignoring inflation. If instead you wait until 35 and invest the same amount for 30 years, you could end near $606,000. Starting earlier is a cheat code because time does more work than amount. In a taxable account, you can also use tax loss harvesting to reset cost basis when markets dip. Sell a fund at a loss, buy a similar but not substantially identical fund to keep exposure, wait beyond 30 days to avoid the wash sale rule, and you bank the loss to offset gains or a slice of ordinary income. It is a nice tool, not a lifestyle. Keep it simple. Finally, think about withdrawal order down the road. Spending taxable first, then tax deferred, and saving Roth for last can maximize tax flexibility for some households, but it depends on your brackets and goals. The point is that ETFs are friendly across account types. Put the highest yielding, least tax efficient assets in tax advantaged accounts when you can. Keep your broad index ETFs in taxable if needed, and let the whole structure compound quietly. Let me stress test this with the traps I see most. The first trap is paying high fees for something you can get nearly free. If a core stock ETF charges 0.5% or more and it just tracks a common index, you are tipping the house every year for no extra value. Fees do not show up on a line item, they just dull your returns. The second trap is going all in on a niche sector because it had a great run last year. Sector funds can be useful satellites once your core is built, But leading with a narrow bet means your results depend on one theme behaving. That is excitement, not a plan. The third trap is leverage and inverse ETFs. They are engineered for short-term trading and daily resets, not for long-term compounding. The fourth trap is trading a lot because the app feels like a game. Short-term capital gains, taxes, spreads, and bad entries stack up quietly. Another subtle trap is owning 5 different funds that all hold the same giant companies. Overlap makes you think you are diversified when you are not. If you own a total market ETF and an S&P 500 ETF, you already own Apple twice. That is not always wrong, just know what you hold. Liquidity matters too. A big, broad ETF with millions of shares traded daily has tight spreads and easy fills. A tiny, obscure ETF can be fine, but give yourself less friction by staying with liquid funds for your core. Timing is another test. You do not need to avoid the open or the close religiously, but placing trades during the most liquid parts of the day often means tighter spreads. A limit order, a few cents around fair value, is a simple guardrail if you want one. On bonds, remember that interest rates and bond prices move in opposite directions. A broad bond ETF holds a mix of maturities, so it will wiggle less than long-term bonds but still move. If rates rise, bond prices dip and yields reset higher. That is not a bug, that is how the reset works. On international stocks, be aware that currency swings can add noise. Over long stretches, global diversification can help, but you can build wealth perfectly well with a US core if that keeps you consistent. Finally, rebalance without drama. If your 80 and 20 mix drifts to 86 and 14 after a hot year, direct new contributions to bonds or trim a little. Once or twice a year is plenty for most people. The North Star is always the same: fewer decisions, lower costs, and enough patience to let compounding do the magic. I will rapid fire the questions I hear most, but I will keep them useful. How much do you need to start? If your broker offers fractional shares, a single dollar gets you in the door, but the habit matters more than the number. Pick an amount you can automate every payday, even if it is $25 or $50 to begin. Are ETFs safe? No investment is risk-free, but a broad market ETF spreads your risk across many companies and tends to mirror the market. Over long periods, markets have trended up with bumps along the way. Safety here is about diversification, time horizon, and your own behavior. Should you pick individual stocks instead? You can, but most beginners get better results spending 0 hours on analysis and using ETFs for the heavy lifting. If you love research, carve out a small sandbox for a few stocks later, maybe 5 or 10% of your portfolio, and treat it as optional. How do you choose between a total market fund and an S&P 500 fund? Both work. Total market includes small and mid caps. S&P 500 focuses on large caps. Over long stretches, they often move similarly. Pick one with a tiny fee and strong liquidity and stick with it. What about dividends? Many ETFs pay quarterly dividends. Turning on automatic reinvestment buys more shares for you, which accelerates compounding. If you need income later, you can turn reinvestment off and let them pay into cash. Do you need international stocks? You do not need them to succeed, but they can diversify your sources of return. If adding them makes you more likely to stick with the plan, add a simple, developed, or total international fund as a slice. What if the market drops right after you buy? That happens to everyone at some point. If you are dollar cost averaging, the next purchases happen at lower prices, which is the quiet benefit of a steady plan. Can you change your allocation later? Yes. Life changes more than your risk tolerance quiz does. If you get closer to a goal or your income becomes less predictable, add more bonds. Just avoid changing the plan every time the news cycle flips. Finally, what do you actually look at month to month? I check that the auto transfers hit, I skim the expense ratios once when I pick funds, and I glance at performance quarterly. I do not micromanage daily prices. Your time is better spent increasing your savings rate by a point or two by trimming one expense than refreshing a chart. That is the calm confidence we are building. You now have the full map from zero to a functioning ETF plan. You know what an ETF is in plain English, why broad low-cost funds are the backbone, how to open the right accounts, how to place your first trade, how to automate contributions, and how to avoid the traps that steal returns. The change we made together is subtle but powerful. Instead of waking up each day needing to guess what happens next in the market, you have a system that does not care what happens next. It just keeps buying, keeps compounding, and keeps your attention available for the rest of your life. If you want a concrete next step, pick a dollar amount you can automate this week and write it down. It can be small. Commit to one broad US stock ETF as your core. Add a bond ETF if you want a smoother ride, and set 2 calendar dates to review and rebalance. If you are in a 401k with a match, make sure you are getting all of it. If you have been on the fence about an IRA, open it and fund it with whatever you can. This is not about perfection on day one. It is about building a conveyor belt that moves money from your paycheck into assets that grow without demanding attention. Over time, your savings rate, your fees, and your ability to stay put will matter more than any single hot pick. Here is my ask to keep the conversation going. Drop a comment with 2 things: the first ETF you plan to buy and the monthly amount you are committing for the next 3 months. Put it in writing so future you has a promise to keep. If this guide helped you feel calmer and more capable, hit like and subscribe so you catch the next round of practical breakdowns we will build on top of this. I will keep testing models, translating the tricky bits, and showing you how to fit them into a normal life. You do not need a finance hobby to build wealth. You need a plan that is simple enough to do on your busiest week. You just built one. Now let it run and get back to your life.